This year, Canadian fintech founders raised $2.24 billion across 60 deals in the first half of 2025, despite a drop from last year's record highs. Fintechs in Canada remain resilient, catching up to the normalization of global investment after last year's mega deals. And every great deal starts with a great relationship. A relationship between an investor and a founder can make or break a round. Here, to have a candid conversation about fundraising in fintech, please welcome to the stage Principal at Luge Capital, Laviva Mazhar, and CEO of Loop Financial, Cato Pastoll.
Yes, all right, awesome. All right, so just quick intros. I'm Laviva Mazhar. I'm a principal at Luge Capital. It's a fintech-focused venture capital firm. We invest in early-stage fintech startups across Canada and US with 180 million under management. And I wanted to invite one of our portfolio founders, Cato, who runs Loop Financial, and I'll let you introduce yourself.
Hi, everyone. My name is Cato Pastoll. I'm the founder of a company called Loop Financial. Loop is a business banking platform, so we help Canadian companies build their business here in Canada with access to better financial services, and we also help them as they grow internationally. So we give people the ability to access accounts, banking, and payments all around the world, including in the US, UK, and Europe. We've been building the business for a few years now and excited to be here today.
Awesome. So the format today is going to be a bit different. We're representing different perspectives, investor and founder. So I'll be asking Cato a few questions about the funding environment today, and Cato will be doing the same for me. So I'll kick things off here. Obviously, Loop has gone through an interesting journey as a business. Can you talk through that a little bit to set context, and especially in the context of navigating fundraising along the way?
Yeah, absolutely. So we started Loop about 10 years ago, and we've been through probably more interesting journey than most with a lot of ups and downs. The thing that's kind of kept us grounded throughout our entire history has been the reason we started the business was to help companies be successful. My parents were small business owners. I grew up in a small business family, and the idea behind financial services was originally to support small businesses, and we felt that traditional banking had gotten away from that. And so we created Loop with the idea of making it easier for businesses to do business every day, to manage their money, to access capital. These are all things that financial services are meant to help small business owners do. And so through our journey, while we've had ups and downs, we went through a pandemic where small businesses were going through a really tough time. The thing that gave us the resilience and the ability to keep going was that small businesses and helping small businesses was our mission from day one, and we were able to kind of navigate a lot of challenging situations by staying focused on that goal and mission as a company. And so we had to kind of reformulate ourselves. The first couple of years, we actually built the company with the intention of creating a lending platform. So lending was our primary product. And as we evolved and realized that, especially in the pandemic, lending was a very challenging space to be in. We continued to stay focused on our mission, but reevaluated, what the best way to build the company would be, and we managed to kind of make a big pivot and find the right partners and supporters to continue to invest in the business throughout that transition.
And did you raise capital before and also after the pivot?
Yeah, so we'd raised a couple of financing rounds before then, and then when we pivoted the business in 2020, we took a couple of years to kind of restart the company, bring in our new products that we wanted to take to market, and then we raised another round in 2022. So not a straight line, but the thing that you learn as you're building a company is that very few things are in a straight line and up and to the right. There's a lot of troughs and valleys on the way to building a company.
I would say the same applies to venture as well. All right, so you've raised capital through different capital market cycles. How would you describe the current funding environment for fintech startups?
Yeah, I mean, having been in fintech for a while, before it was even called fintech, we were just talking about building a technology company in financial services, and someone put the words together. The thing that we've seen is or in the early days, you had to build a lot of infrastructure. So you really had to, start from scratch when it came to all the software you're building, all the vendors you're building, the partners you would work with. I think the biggest thing that's changed today is that there's now a lot of different tools, technologies, prefab solutions out there to get products to market a lot faster. And so that also changes the fundraising dynamic, because it's no longer the case that you have to spend millions and millions of dollars just to get your product to market on day one. You can now, get to market a lot faster, and that also means you can grow a lot faster as well. So, from day one, the expectations 10 years ago were, a couple years and a few $1 million to get a product to market, and that was success. I think today, success is much more focused on growth in your user base, growth in your revenue base, and building a company, from a much earlier stage in the life cycle. It's not just about getting to market, it's about getting customers and showing real metrics now.
Gotcha.
I guess, turning that question back to you as an investor in the fintech space, how do you feel about the current fundraising environment?
Yeah, I agree with a lot of what you just said. I'll maybe take a bit of a macro approach and then dive into the micro of it all. And it's a bit of a long-winded answer, so bear with me. I'd say, in the last couple of years, fintech funding overall has normalized. It's common knowledge at this point. On a quarterly basis, that funding may change a little bit, especially being affected by mega rounds and so on. But overall, I'd say last couple of years, funding levels and deal activity have been steady. But when you drill into maybe a little bit of the micro, there are companies that are being able to attract a lot of that capital, whereas other companies that are not. So investors are definitely being selective about the deals that they're investing in, and those that are able to attract that capital are raising pretty quickly, and others are kind of getting left behind, unfortunately. There's a few reasons for that. So I'd say one is, I'm taking a step back here. Some of the recent data from CB Insights, for example, shows that on a global level, the median funding for early stage fintech startups, that round size is actually increasing. So, back in 2023, median early stage funding was around 2 million, and that's now gotten up to 3.3. And that's all USD figures. And I would kind of agree with that from personal experience and just being in the market over the last many years now. And there's different reasons for that. So one would be that the Series A milestone is getting higher and higher. So conventional wisdom used to be that if you hit about 1 to 2 million of ARR, you could go and raise a Series A round. But actually, some of the latest Carta data is showing that the revenue thresholds have gone up to $3 million. And so what that means is at the early stages, so seed round, founders are required to raise a little bit more capital in order to go and actually have the ability to execute on those milestones. The second point is that, especially with these Gen AI tools or even these prefab kind of fintech infrastructure tools, it's getting a lot easier for companies to build and launch products and go to market faster and hit those milestones faster. And I'll refer to maybe some of the data that was released by Andreessen Horowitz. It's not specifically for fintech, but more so Gen AI type of solutions, which is bleeding into fintech, obviously. And these types of companies, at even the median quartile, are hitting 2 million of ARR within the first 12 months of operations. So there's a lot of pressure on founders to actually go and execute those kinds of milestones in a shorter and shorter period of time. And so in order to compete with that, you need to be able to invest, and hence the round sizes are getting bigger and bigger. So, just wrapping it all up here, I would say that you've got the haves, the founders that are attracting a lot of that capital, and those that are not being able to demonstrate that momentum as well are unfortunately not being able to, have the right round size dynamics and so on.
So with that being the current environment, like as a VC, how are you evaluating opportunities? Like what does it take for a founder to successfully raise a round in the market today?
Yeah, so obviously speed of execution, like I said, and showing some of that momentum. In fintech specifically, I'd say there's maybe a few things that are worth calling out. So one is uniqueness of the solution. So, obviously fintech has been around, you said, 10 years ago, didn't even have a name, but a lot of the kind of known problems have already been solved by, companies that have scaled. Think of the neobanks of the world, the type of models that Wealthsimple has, and so on. And so, investors are looking for unique problem and solution fit, which still presents a very big opportunity for us to have a large outcome. Second, I would say is defensibility, because especially as, again, these AI solutions and these prefab infrastructure, fintech infrastructure plays are making it easier to launch products, how do you actually build a defensible business, right? And it's not that you're just competing against existing players, but there are tons of companies that may enter the space in the next couple of years because it's getting so much easier to launch. So, defensibility could be in the technology. It could also be in your go-to-market. Maybe you have some unique distribution that others have not been able to identify. And I think the caliber of the team has become even more important because, if there's no defensibility, then, you'd bet on the team that you are really bullish on to go and actually, figure out how to set themselves apart in the long term. And so that brings me to my last point, which is the team. And so, within the team, one of the interesting things that we're seeing is that the first generation of fintech scale-ups have created a lot of strong operators who are now coming back into the market to, launch their next business or launch their first business if they were, let's say an employee within these large organizations. And so, that is also another profile that investors are being attracted to. Not the only one, but I'd say, again, in the spirit of quick execution, being able to launch and operate quickly in this space that's very regulated and so on. Founders that have done it before or founders who have done it before within, a broader executive team are attracting a lot of interest from investors as well.
Awesome.
So going back to you, obviously we've been talking a lot about venture funding, but I guess, how do you see founders and small businesses today approaching growth differently than you did before?
Yeah, I think it's really, we were talking a little bit before about like how much the landscape has changed. Loop works with thousands of small businesses, and through that lens of working with businesses every day, we get to see what's changing in the market and in the environment. I think one of the biggest things that we've seen is a few years ago it was really about growth, like growth at all costs, and that was usually the only metric companies cared about. I think today a lot of people are starting to really think about cost optimization, about profitability, about other metrics that represent sustainability in a company, and we see that both from like technology companies, but also from regular small businesses that are out there because I would say investors and raising capital is now more selective. A lot of people are thinking about what is the right way to build a company. I think personally that's a much healthier landscape and environment to be in. And I also think for us as a platform, building financial tools to help businesses be successful, that gives me a lot of excitement too because we are able to help companies in that way. Like every single day we're able to identify cost centers for businesses, like for example, foreign exchange is an area where a lot of companies lose money, and if we can save companies 5% to their bottom line, that's a huge win for a company. And people are starting to take a look at things like that today. So it's no longer the case that everyone is just focused on growth and getting to that next round of funding, but now people are also thinking about what is the best way to structure my business, and other different ways to get to potentially profitability, other growth levers that I can pull as I'm building and scaling my company. I think the other thing that I would say in terms of working with a lot of businesses out there is that more and more people see different types of growth opportunities. I think again, one other trend line that we've seen change is more and more companies today are global by default. Like they start their companies with the goal of having customers around the world, suppliers, potentially even employees all around the world. That's something as well that's changed in recent times, and it definitely has changed the lens at which people look at how to capitalize their business and how to grow their business. And that's kind of one of the founding theses behind us starting Loop and us building our own company is, we really believe that the future of business is global. We think that companies are not going to be constrained by geographic borders. They're going to be doing business all around the world. And so when we think about how companies are built, we think that's going to be a big part of the future. I guess maybe you're thinking about what you're excited for the future, Laviva. What are you looking at as an investor? What are you excited about?
I'll just take a step back and I'll just say that I totally agree with everything you just said. I think from an investor perspective too, I know I just talked a lot about growth and fast momentum and all of that, but I would say the big difference between now and maybe the 2020 2021 environment was that, or even maybe leading up to that, is that it's not growth at all costs. So the sustainability point and growing in a capital efficient way, that is something that we love to see as well. And I think that as early stage companies continue growing and are looking eventually for exits and acquisition, I think from an acquirer perspective, that becomes really important as well. So yeah, totally agree with that. So yeah, moving on to areas that we're excited about. Obviously, we spend a lot of time studying different areas, and we're always updating our thesis and so on. I'd say some of the areas that at this very moment are interesting for us is, I would say one is, broadly speaking, anything in the office of the CFO. So that could be something like AI-driven planning and analysis support to supporting with back office automation. It could be around auditing. It could be, how do I, sell my business and M&A activity. It could be vertical finance within a specific industry. So let's say accounts receivable automation, payable automation within heavy industries, third-party logistics. So I kind of broadly put it as the office of the CFO. Second, in the wealth side of things, we continue to be excited about the massive wealth transfer that has already been in motion. And particularly, I would say, retirement planning, estate planning, especially going through the financial institution and financial advisor channels is kind of interesting. Similarly, on the capital market side, alternative assets. So, investing in private equity. Companies are staying longer, private longer, and there's value there, for example, or other types of alternative assets. And how can the everyday investor or the wealth channel access that, which has typically not been accessible? So overall, the infrastructure on alternative assets is another one. Stable coins, I know that was a bigger topic earlier today. Infrastructure around that is also interesting, and we're following that space very closely. And yeah, I think overall just helping financial, we're backed by financial institutions, and so companies that are helping financial institutions, improve their operations, be, better at serving their customers, that always continued to be a theme that was interesting for us. And maybe last but not the least, more of like an area that I'm personally excited about is know your agent. So, the workforce in the future company is going to change. That would be humans as well as AI agents. And so just the way that we kind of, look at the identity and access management of human workforce, how will organizations handle AI agents, their access to information, what they're allowed to do and not allowed to do. And so the whole kind of management of those AI agents is another area that's kind of interesting for me personally. So yeah. Awesome. Well, I think we're close to kind of wrapping up. Any last words?
Yeah, I mean, I think like there's a lot of excitement, and for those that are founders in the room, I think there's never been a better time to start a company. There's a huge, Laviva just rhymed off a whole bunch of amazing opportunities to be building in. I think one last comment I'll make is that we're definitely starting to see more of a blurring of lines almost between the different things that are capable, or you're capable to build as a founder. Many different like spaces and industries that used to be very siloed or monolined are now blurring together. You were talking about building, for example, for the office of CFO. A lot of products are now building for that, but also building in for wealth management departments, et cetera. So I think as founders that are building, there's so much opportunity now to build great products and services.
Yeah, I completely agree. And I know that, the Gen AI space has been attracting a lot of capital, but I think, anecdotally, Fintech continues to be an area that's exciting for investors. It is one of the, financial services overall is one of the largest contributors of GDP in Canada, in US, and globally. And so I think that it will always continue to be a space that will be interesting to investors. All right. Thank you so much for being here, and I enjoy the rest of the day.